Okay, so this is just a little video going through the notes that we've already gone over for investment. So key definition, investment is the addition to capital stock of the economy. So investment is things like factories, machines and stocks of raw materials. In economics, an investment only takes place if something real is being created, e.g. a new machine. It's not savings in a bank. There's a distinction to be made between gross and net investment, because when we look at investment, we have to take into account depreciation, which is the value of an asset over time. Depreciation allows to ensure that in an accounting sense, that the value of an investment doesn't remain high when the actual value of the asset itself has fallen over years. There's a distinction between human and physical capital. Physical capital is factories, whereas human is things like education and investment into training. Investment can take place by private bodies as well as public bodies, such as the NHS or firms such as Nissan. And investment is absolutely crucial in supporting growth in our economy over the longer term, shifting out that PPF. Now, this point here is really important because it allows short-term growth, as we'll look at in a few videos time, a movement of our aggregate demand curve, but it also allows for shifting out longer term and shifting out of our aggregate supply curve. Investments affected most notably by changes in interest rate. Often firms need to borrow for them to invest, and therefore if the interest rate changes, that's going to affect the amount that firms are willing to borrow. So if interest rates rise, it's going to be more expensive for firms to borrow, and they may decide it's no longer worth their while. So what firms will often do is they will have a look at how much they expect to gain from the investment and see whether or not it's worth to borrow the money in the start. Okay, investments also may be made through retained profits. So if interest rates are low, there's less incentive to save this profit because of the fact that you're going to receive less in the bank, and therefore more incentive for you to invest it into a new machine or some training. Whereas if interest rates are high, there's less incentive to invest because you can make so much more out of keeping the money in the bank. Business expectations and confidence are really important, because if interest rates are high, it's going to be more difficult for firms to borrow. And also, firms will assess the market to see whether or not they can sell the goods in the future. So if interest rates are high, they're less likely to borrow the goods because they think that consumers will be less likely to actually buy the goods because interest rates are high and they might not want to spend extra cash on these particular products. It will obviously all depend on the elasticity, the income elasticity demand of the product, because obviously if interest rates are high or we're going through a recession, then people might buy more inferior goods, and if you're producing more inferior goods, then obviously you may decide to still invest. Keynes mentioned the idea of confidence or animal spirits. He said they were very difficult to measure, and it was a feeling that businesses had about whether or not they felt confident about the future. And these feelings or these animal spirits are really important to how much firms will invest, because if they feel confident about the future, they're far more likely to do it. Other key issues: world economy. What's the demand like for our products? How easy is it to export to those areas? Questions like that are going to affect investment decisions. So we've seen through Brexit at the moment that has massively affected the amount that we can export abroad, because it's not as easy for us to export due to the new trading conditions. How easy is it for firms to access credit? During the financial crisis, it was very difficult for firms to borrow, even if they were profitable, which meant that levels of investment fell significantly. What about retained profits for firms? It's easy and cheap for firms to finance investment through retained profits, and many firms use these retained profits for their future investments. And what about government influence? Governments can support investments by using taxation on profits or guaranteeing loans and subsidising on certain types of investments due to apprenticeships. So this can have a huge impact. In 20 21, Rishi Sunak, as Chancellor, announced a significant package to support investment in new in research and development, and also for apprenticeships to try and support longer term growth with our economy. So keys to investment to understand: human versus capital investment, public and private sector all invest. Animal spirits and confidence is key. The impact of interest rates, government policy, exports, and the availability of credit.